So Carl tallied it up. We're down about 1.3% on stocks for the week going into today, which looks like it could be a positive day. Where is the market right now on the trade risks, the Brexit risk, the European parliamentary risk? I mean, how much have we moved the ball forward this week in terms of pricing in negative scenarios?
A lot of it is in, but it's not all the way there. Let me level set. So taking a 12-month view, I think there are more pluses than minuses in the fundamental outlook. You have a U.S. economy that's moving along at trend or slightly above trend. You have monetary policy that's comfortably on hold. That's an underpinning for financial conditions globally. And it's our view that sometime before the presidential election, you do get some type of stopgap, narrow agreement between the U.S. and China. So on that score, you'd say equities are probably up in a year's time. Where does it go between now and then, I think, is a big question. There's a lot of volatility that might still occur. It's impossible to rule out a rerun of Q4 of last year. And so when you think about equity positioning, it's hard to get away from the fact that equities as an asset class are somewhat lower Sharpe ratio than usual at the moment. And so I think, if you're leaning into risk, there are probably lower volatility ways to do that without blowing your risk budget, thinking about credit as a way of playing positive fundamentals, and maybe trying just to ignore the noise for some time.
All right, so we can either have a delay, right, in putting off the inevitable in terms of this face-off with China, but what would the contours of a narrow deal look like? Because the disagreements are not narrow by any scope.
Well, when you think about the sort of compartmentalizing, what would be parts of the agreement? China buys more U.S. exports. That's going to be a big part of it. Market access for U.S. firms operating in China, something China had already pledged to do, could be accelerated. More fundamental issues having to do with intellectual property. I mean, the balance is going to be heavily skewed towards a transactional approach, China buying more U.S. goods. There will be some issue having to do with intellectual property, but that's not going to be the bulk of the agreement. What the entity list reminds us is that this is all taking place in the context of the broader strategic rivalry between the U.S. and China. I think it's a broad, it's probably too much to ask for a narrow agreement to solve that. We'd expect this to be an issue generally for some time to come.
Would you expect, if we got something like that, for these growth indicators to reverse? Right, because a lot of the PMIs were suggesting slowdown before talks fell apart.
Timing is a key issue, as you mentioned, right? The trade war is corrosive to the economic outlook, right? So the durable goods this morning was a good example of that. The longer this goes on, it wears on business sentiment, it wears on capex, it wears on all the upside in the economic outlook. So I think it just puts the outlook on a much more even keel than would have been otherwise had we'd been expecting earlier this year.
Does it wear down Brian Belski's bullish call?
No, no, because we're longer term and we're not reactive. I think anybody that's reacting off of a 4% pullback in markets after the S&P 500 was up 26% the day after Christmas until April 30th is very short-sighted. Clearly the international components of technology, energy, materials, and industrials have been hurt this month, but give me a break. Technology was up 36% between those dates that I gave you. So this is a give back. Bit of a rest. We are too reactive. And every time you have utilities hitting new highs, they're the most expensive asset with respect to valuation in the U.S. market. In REITs leading the charge in terms of sectors, investors have remained too defensive. Now, the market and investors and comments, we're trying to thread the needle on this China deal. This China deal is going to take some time, but any kind of accord, I think, would be positive. But this is not going to, the first accord is not going to be the last accord. And I think the markets are going to be volatile. Anybody can say that, but then how do you invest in that? We think a return to more traditional value, fundamental metrics to be building portfolios, but also dividend growth is a way for investors to save their profits and invest back in equities. Lastly, I think all this volatility in terms of what's happening in Europe and emerging markets is actually positive for the United States. And don't discount how stable earnings are in the United States relative to the rest of the world. And that's why we think we're going to see rotation back into the U.S. based on this volatility, not only in emerging markets, China, but what we're seeing in Europe and the UK.
So is the advice, Ben, to the positive sectors so far this week are utilities, healthcare, and real estate. Brian's worried about the valuation in a group like utilities. Do you just have to hold your nose and buy because that's what's working in this sort of jittery market?
Yeah, I'm not sure. That sector rotation story has a lot of countervailing forces in it. I think I'd rather look at it from a regional perspective, where one of the lessons we learned in 2018 was that the shocks coming from geopolitical issues are much more persistent outside the U.S. So where I definitely agree with Brian is that what this is telling you is that the volatility might just be more noise in the U.S. and more persistent elsewhere. So bringing back some of that exposure to U.S. equities would be a good idea here.